Okay, I'm going to leave my mic on the whole time. You too, to comment.
Okay, it looks like we're just about ready. Welcome everybody, good morning. My name is Kay Gottschall. We're going to talk about state and local. I appreciate you guys joining us this morning. A few administrative things. Terry, if you could advance the slide. I know that state and local is a great topic. Me and Terry love to talk about it, but I know you're also here for, some of you also here for CPE. So make sure you stay connected to the program, and also make sure you respond to 3 of the 4 polling questions that we're going to have. And also, if you meet all the criteria and you get your CPE certificate, it will be emailed to you from Eventbrite in about 3 weeks. So look for that. And then also you need to fill out the evaluation as well. So we're doing it on Zoom this year as opposed to Teams in the past. There is a Q&A box. If you have any questions, please make sure to put them in the Q&A box. I want to go ahead and introduce myself. My name is Kay Gottschall. I have been with Kiter for about 19 years, and I specialize in state and local. Love to talk about it. So I deal with clients in different industries, anything from financial planning to manufacturers, professional services. State and local affects a lot of different industries. So I deal with pretty much compliance issues with income tax and sales and use tax, income tax and franchise tax. And then Terry, why don't you go ahead and introduce yourself real quick, and then we'll get into the presentation.
Yeah. Hi, I'm Terry Barrett. I'm sorry we can't be live and in person like we normally are for this CPE Day SALT event, but I guess this is the next best thing. So, you know, happy to have the opportunity to talk with you all about state and local tax issues. I'm Terry Barrett. I'm a tax senior manager with Kiter. I've been here about 6 years. My focus at Kiter is more on the consulting side and dealing with a lot more of the indirect tax issues, sales and use tax, property tax, business license tax, although I do consult on nexus issue, income franchise tax nexus issues. So, and my work kind of crosses all industries. And so regardless of what you're doing, you know, that you potentially have issues that I can help you with. So, yep, we'll move on to the next slide in the presentation.
Great. So the objectives today, we're going to talk a lot about recent developments, look at how COVID is affecting Nexus and teleworking or telecommuting, how that's creating some issues with COVID, and then also understand and what to expect from states in the future, state and locals, with future compliance and audits. As far as the agenda, I'm going to start off with CARES conformity, which is more income tax issues. We're going to talk a little bit about some recently notice that was received regarding the state and local deduction. And then we're going to go into COVID-19 teleworking issues and how kind of that's affecting income taxes and sales and use taxes. And then Terry's going to finish up with compliance and consideration. So we're going to see what's happening in the state and local over the next hour. So on to our first polling question. You should see the polling question come up. There it is. Just want to give you a minute to go ahead and answer that, if you could, and then we'll share the results. So we're kind of looking at where you guys are working nowadays. As I said, there's really no wrong answer on this. We are just making sure that you guys are attentive and paying attention. We have to do 4 polling questions in the whole 50-minute to an hour presentation. So go ahead and answer the polling question. One thing to note, once the polling question closes after the minute, you cannot go back and answer it. So make sure within this next 30 seconds or so, you click which area you're working in. Hopefully you will tell us. You could answer, prefer not to say, but it's interesting to kind of see where participants are currently working. You know, I noticed the vacation home there. Some people may be working in their North Carolina home down in South Carolina. So go ahead and answer your poll. I think we're just about at a minute. Claire, everybody has hopefully participated in this polling question. So we're about 95% who have responded right now. We'll give you just a few more seconds, because we're about a minute and a half. So Claire, let's go ahead and close the polling question so we can get the survey, the results. So look, COVID is definitely people, 57% are working from home. There are quite a few, I'm surprised, 42% are working in the office, and not too many people down in their vacation home, which is surprising, because if I had a vacation home in North Carolina, I might actually be there. So let's close that and move on to starting the presentation and get into some of the meat of this. As you guys may have heard, we had the tax update and the audit update, I think it was a week or so ago. Vince and Chris Wallace put it on. The coronavirus CARES Act had a lot of key provisions as well, tax provisions, one of them being the PPP loan. But I'm going to talk a little bit about the key provisions of the CARES Act. A lot of tax favorable provisions in here. A lot of you may have already received, or should have already received, or may have received the stimulus check that was given this past summer. But as I mentioned, one of the key provisions was the PPP loan and the forgiveness and the potential, I say potentially non-taxed. It's Congress's was saying that it was going to be non-tax, but the IRS currently has said that in a notice that since it is tax exempt income, any direct expenses that are related to that are going to be non-deductible. So that's kind of, we want to make sure everybody is aware of that right now. That's the current guidance. We're hoping to get more guidance or some type of Congress that gives us some additional information on that. Another big key feature were the NOL carrybacks and the TCJA. The NOL carrybacks were eliminated, but CARES Act that was passed in March of 2020, they allow for a 5-year carryback for 2018 through 2020 years. So a lot of good benefits here for businesses. Another item, which is mostly for individuals, is the excess business loss. There were some limitations on excess business losses that were put into play in the TCJA, and under the CARES Act, there's been some suspension of those limitations for a few years. Another big item that hits some larger companies are the interest limitations. Right now, under the TCJA, there was a 30% of adjusted income limitation on interest expense, and that's been increased for corporations only, not partnerships, to 50% in 2019. And then in 2020, it goes up to 50% of adjusted income, this limitation for partnerships as well as S and C corporations. So this is any type of excess interest is going to be flowing through on partners K1s, and that can really complicate some of the state filings if you have this coming through. And then one of the last key issues, and these are mostly the key issues that we're dealing with, are the clarification for qualified improvement property, or QIP. Back in TCJA, that there was an error in the bill and it made the QIP be 39 years. So starting in 2018, it was 39 years. So this bill passes, the CARES Act actually passes a long-awaited technical correction to get it down to 15 years. So now we've gone over the key provisions, let's kind of talk about state responses. Just real quickly, states kind of fall into one of 3 categories as far as how they conform to the Internal Revenue Code. They start with basically the federal base, and then they have, adjustments to them. Some states have a fixed date adjustment date, as in such as Virginia. Right now, currently, Virginia conforms to the federal law as of December 31st, 2019. And other states may have like a rolling conformity, and then some are, which are limited. They select a certain time where they actually pass some legislation, and that's when they then conform to federal changes. But some states right now, due to COVID, have not passed much on the CARES Act. Some states have announced additional guidance on what their plans are. So there's a lot of variety of how states are responding to the CARES Act. One thing to point out, though, is the CARES Act is very favorable to taxpayers. So if a state does conform to it, it's definitely going to be costly to them. So I would imagine a lot of states, if they're really looking for money, there's going to be a high chance that they are not going to conform to a lot of these CARES Act items. And the other thing to note is, due to some of the complexities like interest limitations or the NOL carryback, if states do not conform, it's definitely going to complicate the filing of tax returns and the adjustments. So it'll limit, kind of what kind of deductions taxpayers are going to be able to get in these states. So let's specifically move on to Virginia. As I mentioned, Virginia has a fixed date conformity. So as of December 31st, 2019, and since CARES was passed in March of 2020, there has been no conformity to anything. So any of those items that I talked about, specifically the qualified improvement, which goes to a 15-year, Virginia yet has to conform to that. So if a taxpayer filed a tax return and they had property that they reported for federal purposes a 15-year, it had to be 39-year for Virginia purposes. Or if they had a carryback for 5 years, maybe they had a loss in 2018 or a loss in 2019 and they carried it back 5 years, they definitely would not be able to do that for Virginia purposes. So right now, no conformity for Virginia. Historically, though, Virginia has not conformed to the 5-year carryback, so I would anticipate them not doing that again, but maybe, so they'll surprise me. But they have conformed to the 15-year qualified improvement property, so I would imagine they would do that as well. So we'll be on the lookout coming the new year. Hopefully, they will pass a bill that kind of gives us some guidance, because the sooner the better when we start in busy season filing 2020 returns. It's hard to hold a return for Virginia waiting for legislation. So definitely am looking forward to getting that, and we'll get some blogs out and look for what they're conforming to and what they're not conforming to.
Yeah, and I think it's important to note, Kay, that with Virginia, because this is an issue that has to come before the General Assembly, because they don't come into session until early January, and if it's like with the TCJA conformity issues a couple of years ago, it might not be until late February or even early March when we know. So I think just, everyone needs to kind of monitor Virginia's conformity, because it might be kind of late in the season, at least from a tax preparation perspective, before we get the news.
Yeah, they're going to make our lives real fun come March.
Yeah, challenging year.
I know I sent an email. I think Virginia side of CPAs was pushing Virginia politicians to try and pass something for CARES, and that hasn't been done yet. So maybe sooner than later. So moving on, just very recently, actually within the past week or so, we got some clarification notice from the IRS. Many of you guys may know and even be affected by this. For federal purposes, under the TCJA, there is a $10,000 limitation for taxes, and that includes income taxes as well as real estate taxes, state and local taxes. There's a $10,000 limitation at the individual level. Well, a lot of states kind of were trying to get around that, because it really was affecting businesses, pass-through entities, that have a good amount of money. It didn't seem fair that C corporations could deduct state taxes over the $10,000, but individuals who had businesses, legitimate businesses, were getting disallowed this $10,000, limited by the $10,000. So several of these states, Connecticut being the first of them, made a mandatory entity level income tax. Several states followed suit. You can see here on this list, the E meaning that it's elective, and then you can see the dates that it's effective. So what we did get some clarification from the IRS was they issued notice 2020-75, and they basically clarified that these types of taxes would not be limited by the $10,000 and they could be deducted by the business. So that's good news for taxpayers. And the one thing though that we do need to, that'll still probably be a question, is going to be how are these taxes, if they're expensed by the entity, generally speaking, when they're paid by the shareholder, all the income that passes through the shareholder, the partner, is taxed 100% in their state of residence. So say, for example, I'm a Virginia resident and I have an S corporation that files in North Carolina and maybe West Virginia. So I pay taxes in West Virginia, North Carolina, and I get a credit on my Virginia return for the taxes I pay, so I don't double tax on it. So the big question, I think, which is more at a state level, is are these taxes that are paid at an entity level going to be creditable for out-of-state taxes paid on the state of resident return, so that the individual is not double taxed? So that's something I think we're going to be hopefully looking for. Of course, there's if Biden gets into the office, or when Biden gets in the office, whichever way you're looking at this, he may revamp the tax code, and all bets may be off because the $10,000 limit may be gone. So we'll have to see. Too bad we didn't have our crystal ball to tell what we're going to do. So that's one of the things that we're kind of looking for. So next slide. So we have our next polling question. Which of the CARES Act's key provisions is most important to yourself or your company? Again, there's no wrong answer here. We kind of already went over the key provisions. These are some of the key provisions. I couldn't put them all on there, but go ahead and please respond to the polling questions, and then we'll keep it over for about a minute. Not difficult. And if you don't work for a company or you're individual, which one would you think would be more important to you or your company? Go ahead and respond that so that we can then share the results. So it's been about 30 seconds now. Got my little handy timer over here, make sure we stay on track. But yeah, the PPP loan or the qualified improvement 15-year, the NOL carryback provisions, or the 163J provisions. Either one of those. Let me see kind of where we're at as far as percentages. We're at 92%. So give another minute or second or two, not minute, second or two. Okay, so go ahead and we'll go ahead and close that, and then we can kind of share the results. Yes, that is not surprising. The PPP loan forgiveness, that is very key. I know a lot of people got that, the PPP loan, a lot of our clients. And we're really hoping for more guidance on that so that we know kind of how this is going to affect expenses, because I know Congress's intent was to be non-deductible or non-taxable, but if they make the expenses non-deductible, that will obviously increase income. So let's move on to the next slide. Look at the time. Okay. COVID, telecommuting issues, impact of teleworking. So there's a lot of different impacts of teleworking or telecommuting. Some of them, which we're not going to go into too much, may be need for registration in a state where you've got now an employee. And this is really going to affect companies that have somebody, an employee that's teleworking in a different state than what they normally work in. So maybe companies more up in Northern Virginia by Maryland and DC area, or maybe down on the border states, North Carolina. So those are really the ones that are going to be affected by this. So, maybe possibly new registration if you've got somebody working in a new state that not normally is there, potential for unemployment. or workers' comp insurance, that we may have to look at that something differently. Also apportionment factors, we use apportionment factors to apportion federal income to the different states. And one of the factors is payroll. Some states have responded to surveys that say that it's not going to affect state apportionment factors due to COVID. So definitely it's going to be affecting a lot of things. Other things which we're going to go into in the following slides is going to be payroll withholding, income tax nexus, and then sales tax nexus. So we'll move on to income tax withholding. So I put a picture here of the W-4. A lot of states, most states, obviously Virginia has the VA-4. So that's something that you're probably going to be looking at if you have an employee that's maybe has changed a state. So next slide, Terry. So generally speaking, withholding is required in the state in which the services are performed. So if you have somebody who now is working in their state of residence when they used to work at the home office, you may have to look at changing the state of withholding, which you're having to withhold on. Now, there are some exceptions to this general rule, the de minimis rule, where it may be a small amount that they're earning, or the reciprocal agreements. There could be, like, for example, between Maryland and Virginia, a reciprocal agreement where that would change this general rule. But for the most part, it's where the services are performed. And several states have different thresholds from which you are required to withhold, you being the employer. And it can be anywhere from, a number of days down to a week or 12 days up to, 60 days. Or some states have an income threshold, which could be, as low as $500 or $300 up to as much as $5,000, just depending on the state. And that would require somebody to withhold. Now, there are multiple issues, and I don't know how many traveling people we have right now under COVID, but that can raise some issues. Or maybe you have somebody who was a traveling salesperson to different states, and they apportioned or allocated their wages to different states, and you had several states withholding. If that person's no longer traveling, then you would need to look at that as well under COVID. So several states have announced that that you need to look at also the convenience rules for the employer. This is a rule basically where they say if you have an employee who is not working in the state in which the office is at or which they normally work at, the only way you would need to withhold still from the state in which they're supposed to be working, only unless it's a convenience of the employer. So you would not need to withhold if they're working in a different state if it's for the convenience of the employer. So I guess the question is, with COVID, is this for the convenience of the employer or not? So definitely something to look at. There's only a handful of states that have that rule, but it's definitely something to look at. So let's look at some other items that states are passing. Terry, next slide. Massachusetts has been a little aggressive, and they have been known to be aggressive. They're one of the few states that have the cookie nexus, but they've basically come out and say, which is similar to the compliance rule that I said, I'm sorry, not the compliance rule, the convenience of the employer rule. If you have somebody who normally works in Massachusetts, but due to COVID is working in a different state, a surrounding state or a different state, you still are expected to withhold Massachusetts tax. So there are some unique positions being taken out there right now with states in COVID. Of course, New Hampshire is not happy with that, and so now they're suing them and for trying to impose withholding tax on non-resident workers. So, and then you have other states such as New Jersey who are reminding taxpayers, being the individual employee, that if they are working in a state that they're not normally a resident of, like say New Jersey, and if they're there for more than 183 days, they're actually going to be filing as a resident. A lot of states have this physical presence rule, or I don't know what you would call it, but if they're in the state for more than 183 days physically, Virginia has the same rule, North Carolina has the same rule, I know California has the same rule. You're going to be looking at filing as a resident, and you could be a resident of 2 states basically when you file on the individual side. So it's definitely this COVID, if you have this issue, and then the question becomes, as far as withholding, is it the burden of the employer or the burden of the employee to determine, if there should be a change in the withholding? I had the W-4 form up front when you maybe recommended when you collect those for the new year, check to make sure that the state that they're withholding is the state where their address is at. Just something to think about. And then lastly, just to talk briefly about the proposed federal mobile workforce legislation. That's a proposed federal law. It's been out there for many years. We keep looking to see if it's going to pass, but it would fix a flat exemption amount of 30 days where somebody could work in a state for up to 30 days and not be subject to the withholding. Obviously, there are some carve outs for high earners, such as professional athletes and professional entertainers who may make a lot of money in one day, where they would still have to file. But so there's that maybe we'll get some relief on that. And so finally, as far as my slides, I'm going to talk a little bit about income and franchise taxes and the nexus issues. So next slide, Terry. So historically, physical presence has been what is being triggered nexus in the past. Now, more recently, over the past 5 to 10 years, we've talked a lot about economic nexus. But we're gonna, since this is dealing with teleworking and actually working in a state, a lot of states have come out and said that due to the pandemic, there is, a period of time that somebody can work in our state and not cause nexus on behalf of that employer or company in that state. So Thomson Reuters did do a survey that was in an article that was published back in June of 2020, and they surveyed the states in the middle of the pandemic. Some of them had some waivers that they were allowing. Up to 14 states say that it would not cause nexus. Some states said that they would be on a case-by-case basis, and then there are other states, who just abstained from saying whether it did or didn't cause nexus. So if you do have the issue where you have an employee who's working in another state, it's definitely something to look at. How can a company take the position that maybe it's an administrative person, so it doesn't cause nexus? If it's a salesperson and they're concluding contracts, then that would be a little bit, where it probably would cause nexus. Is it temporary? Was it 30 days? Is it now going on 6 months? Is it a year? So the duration of the working in that state is going to also be effective. That's why it's a case-by-case basis. There could be other things that you're doing in that state. Maybe you've got catalogs being sent to that state as well. You're soliciting in that state. So definitely a lot of things to consider. So it's, want to be checking that out and looking at the different issues as far as income tax nexus with an employee working in that state. So now I'm going to hand it over to Terry, and she's going to be talking about sales and use tax and nexus and wrapping up the presentation.
Yeah, and first to answer a question that we received, yes, the presentation will be available. We'll distribute it to the participants, so you'll have it to look at your leisure and enjoy later on. But yeah, but as with withholding tax and income franchise tax, employees teleworking can have an impact on potential sales and use tax compliance requirements. With sales tax, we all know physical presence equals sales tax nexus. I mean, some states have some de minimis rules saying if you have an employee in the state only for a limited amount of time, 2 to 3 days, or for trade shows or what have you, then that employee does not necessarily create sales tax nexus. However, if you have an employee who is teleworking from a state full time, I think it's hard to say that you don't have a constant physical presence in the state. So, that's something, that we're thinking about. And a lot of states, fortunately, though, have taken the position or made formal pronouncements, given the COVID situation, that having an employee present in a state solely because of the COVID situation, that employee does not create sales tax nexus. And again, I want to emphasize solely because of the COVID COVID-19 pandemic, because if there are other things going on in the state, even if sales into the state exceed the economic nexus thresholds, that will create sales tax nexus. But if you only have an employee in a state, I mean, they're working just because of COVID, that is not necessarily going to create sales tax nexus. And a few states that have come out with formal pronouncements, Massachusetts, Pennsylvania, New Jersey, which are kind of surprising because they're some of our more aggressive states. They've said that if it's solely because of the COVID situation, that does not create sales tax nexus. So that's good. And other states, according to the Thomson Reuters checkpoint survey, other states have said, hey, yeah, that's not going to create nexus. I mean, it's not a formal pronouncement, which is kind of concerning because I like these formal pronouncements. And then a number of states haven't responded to that survey, or a number of states have said, we're going to deal with this on a case-by-case basis, or some haven't even responded or even made any type of indication as to whether an employee teleworking in a state creates a sales tax nexus. So it's just something to be aware of. You just need to look at where your people are and what they're doing and what the specific state's requirements are. And then we look to the local tax impact. A lot of localities, especially in Virginia, I mean, they've been working very hard to work with taxpayers. I mean, we've had some local amnesty programs. We've had delayed filing requirements or delayed due dates. Some are waiving interest and penalties on delayed payments. But they are hurting for revenues as well. So you have to kind of think about, well, what's going to happen here at the local level? I mean, they're getting some money from the state, from Federal CARES Act, to help support, their continued operation, as well as, some are even providing some grants to local businesses, which, if there are grants out there or grant opportunities, we highly suggest you look into this and take advantage of those. I think yesterday there was an article in the Richmond Biz Sense about Chesterfield offering grants to very small businesses, those with 5 or fewer employees. So, keep attuned to these, because there might be some opportunities available to you. But, you think about, the localities are hurting, and while they're trying to help businesses, at the same time, we've got office downsizing and closures and people working from home. You have a shift in the location of personal property. If somebody's no longer working, say, downtown Richmond, but they're working from their home in Chesterfield or Henrico, personal property, their laptops are in another locality. You also have the possibility of employees' homes considered a place of business for local license tax purposes. For BPOL, typically in Virginia anyway, if you have a definite place of business and the state has ruled that, an employee's home office essentially could be considered as a definite place of business. So kind of have to think about these issues. You've got employees, you've got property in other localities in which they normally are. Are these changes temporary? I mean, for some of us, yes, they are. Might be working temporarily from home because of the pandemic, but the plan is to eventually move back to the office. Or is it permanent? I mean, some people or some businesses are finding that, hey, this works. We intend to downsize our office space. We intend to have our employees telework. I mean, there was an article in the Richmond Biz Sense just yesterday, and I think it was repeated today, about Owens and Minor, where they were saying that while they had a couple of years ago leased some space in downtown Richmond and Riverfront Plaza, for a call center, they're finding that their employees who haven't been working downtown because of the pandemic, they're now telecommuting essentially, or working from home. They're finding that works out very well, so they're subletting their space. So no longer are they going to have 200 to 300 employees downtown. Well, what impact does that have on the local tax scenario, if you will? I mean, those employees aren't downtown spending money on meals and parking and things like that. So it's definitely going to have an impact. We also want to consider the impact on real property assessments. Should you argue for property tax assessments, being lower because of higher vacancy rates, with real property ownership? you also think about the residential real estate market. The housing market is booming because interest rates are lower. So and people are paying, higher than the asking value for homes. So should that raise the assessed value for local tax purposes? And how does that come into play in the overall scheme of things? So, and then also, with the business closures, with the governor's mandate, closing down restaurants and other areas of entertainment, we've had a substantial reduction in, meals and lodging tax payments, for localities. How does this, play into the overall, local tax scheme? I had one client say that they received an inquiry from the locality saying, well, why are you filing zero tax returns, for your meals and lodging tax? And it was like, well, duh, we've had to be closed because of the pandemic. And the response was, oh, hey, by the way, you're now under audit by the locality. So lots of potential local impact here. So lots of uncertainty. Again, is this a temporary situation? Are we going to get the vaccine and everybody's going to be back to work in their old workspace in hopefully soon? Or is it going to continue into the spring, into the summer or fall next year? We really don't know. So it's potentially an impact on localities as well as the state. And the localities are thinking about these issues. So you need to be thinking about them as well. So in summary, the possible impact of teleworking, it's great that employees can work from home, lots of benefits to that, but you also have to think about, as Kay was talking about, with possible income tax withholding requirements, unemployment comp, workers' comp, potential income franchise tax requirements, sales tax requirements, possible Secretary of State requirements, local tax requirements. And then, at the end of the day, depending upon if it's an issue or not, it may result in additional cost and compliance fees and what have you. So a lot's going to depend. We really don't know, but it's just, we're presenting these issues to make you aware that, it's something to definitely be thinking about. You can't ignore them. So now we're going to go to our polling question number 3. Which of these issues already discussed are of most concern to your business? The CARES Act conformity at the state level, possible income sales tax nexus issues created by telecommuting employees, possible withholding tax requirements also created by telecommuting employees, or all of the above. Or it could be none of the above, but that's not an option. So if you will, please, respond to the polling question. We'll give you a few more seconds to respond, and then Claire will show the responses that we've received.
Jerry, I didn't respond to question 1 or 2, and so I went to respond to question 3, and it was like, oh, wait, I'm not supposed to be able to do that.
Yeah, you don't get CPE credit.
I don't get CPE.
Okay? No, I don't either. So Claire, if you could kind of close out the polling on this one. So we've got 91% response. Again, if you don't respond to the polling questions, you don't get CPE credits. And this time of the year, we all need our CPE credits, right? Okay, we have our results. Okay, which of the issues are most important? It looks like all of the above. Kind of takes the lead a little bit over the CARES Act conformity. So yeah, all these issues are of concern to all of us. So it's a tough time. It really is. And so we're now going to talk about, Claire, if you could close that out, please.
Hey, Terry.
Yeah.
There is a question. Is the burden of the state income tax withholding on the employee to notify the employer to make the change of the state withholding? I know we kind of talked about that. It's really going to be up to the employee, but as an employer, if you know that an employee has changed states and is moving into a different locality, you probably want to make sure you talk to them. Even though I would imagine you have some type of, and this is where it kind of get kind of gray, but I'm sure most employers have some type of requirement that if an employee moves, they're going to give you a new address. So that's where, though, the employer then would need to be looking for those changes of addresses and asking the client, hey, now that you've moved to a different state, it's amazing. And I worked, before I was in public accounting, I worked for a pretty large manufacturing company, and it was amazing to me how the HR department didn't talk to the tax department or the payroll department. So if the withholding were to change, or the HR department knows about a change where somebody is moving or living, if they need to communicate that to the payroll department, and then the payroll department would need to take action. And payroll companies are not going to ask us either. I've also been surprised working with payroll companies where they're like, oh yeah, we have an employee in Maryland. And it's like, well, are you filing Maryland withholding? And they're like, no. Well, did you tell your payroll company that person? Because the payroll company doesn't say, hey, this person has a Maryland address, maybe we should look at withholding Maryland withholding. No, they just assume that if they're in Virginia and they withhold Virginia withholding. So I've seen that multiple times. So it's really going to be a joint effort on making sure that you got the withholding right. And that's why I was saying, look at these forms, make sure you know what states they're withholding. I don't know if there's a way to do a report now with all the data that gets dumped out of payroll reports. You could look to see what withholding state they're in versus what their address is. So let's see, follow up on another Q&A. But if they do not change their address but work from a vacation home, and that is going to be tricky. If they're working from a vacation home, you'll have no way of knowing. And then that's really then up to the employee to realize, because you're not filing their taxes, you're not saying where they're a resident, and you have no idea. You might want to notify, you could also notify your employees that if they are working from a vacation home, such as North Carolina, technically, if they're there in North Carolina for more than 183 days, they're going to file as a resident, and it's going to make their taxes awfully tricky. So that's from an individual side, that's kind of on them, I would imagine, if they're not telling you that they're working from a vacation home.
Yeah, but, and I think this is a problem that businesses have, not only with the pandemic, but normally anyway, because it might be a situation where somebody wants to move, or their spouse is moving, or a friend is moving, and so they want to move to this other state too. It's up to the employee to notify the employer of their change in residence, and it doesn't always happen. So it creates issues for employers and employees as to the proper withholding. So it's good for everybody to make a practice of saying, hey, employees, if you're moving or if you're living or working somewhere else, please let us know so that we can properly collect or withhold. But it might be a situation where that it's not the responsibility of the employer to make the withholding, but rather the employee to file quarterly payments or whatever. So it's just, it kind of depends, but it's the key is open communication. Yeah. So if we don't have any other questions on that, we're going to move on to our next issue, which are compliance. With all the COVID situation, the CARES, even normal business, are there new hurdles, or are there existing hurdles, or old hurdles that have gotten even bigger because of everything that's going on? Obviously, the states are and localities having these huge revenue shortfalls, due to reduced tax receipts, and this is going to dictate increased compliance efforts. I mean, like Virginia is projecting a $2.7 billion shortfall over the next 2 years. How is that going to affect Virginia taxpayers? I mean, they've made some changes to the budget, but when the General Assembly comes to town in January, how is this really going to affect us? And also in other states, what are they going to do? In our slide, you see that we had possible, and then we scratched that out and we said kind of expected approaches to this. What do we expect from this? Because states are desperate for money, localities are desperate for money. What are they going to do? I mean, this is kind of like a question that we talk about every year. Is like, it's always a situation where states are desperate for money. So what do? And, one of their easiest approaches is increase audits. So the increased audits of businesses, we're seeing this more, with some of our clients with sales tax audits. I talked to the sales tax auditor. I said, well, what are you guys doing? And they were like, well, we kind of held back a little bit with the whole COVID situation, but now we're going gangbusters. So, just to be advised, you might be getting a call from Virginia because they are, definitely looking for money. And then another option of the states is to send out nexus questionnaires. If you have recently filed your first return or Texas franchise tax return, you will note that, within 30 to 60 days of having filed that, you're getting a nexus questionnaire from Texas. Texas wants to know, hey, thank you for filing your return. What else are you doing in the state? How long have you been doing this in the state? So they're looking for opportunities to, to go back and seek payments for prior periods, not only for the franchise tax, but the sales tax. Washington State is a big state that sends out nexus questionnaires just randomly. It's just like all of a sudden, people get questionnaires from Washington State and they're saying, hey, what are you doing? Your name came up and we thought we'd check to see what you're doing. Some clients say we're ignoring those. Okay. Other clients are trying to respond to those questionnaires. And a lot of times we find that their activity in the state does exceed Washington's nexus requirements. So again, nexus questionnaires, just when you get those, reach out to us. We're happy to talk with you and help you in filling those out. Also, we're thinking, legislative changes, in most states, the legislatures will be coming into session in January. What are the possibilities to come up with these revenue shortfalls? Are they going to raise rates, income, sales, whatever? Or we can have a shift to gross receipts taxes. I mean, it's been kind of a slight trend to a shift to gross receipts taxes in recent years. We've had the Nevada commerce tax, we've got the Oregon tax, so on gross receipts. So states are starting to look at gross receipts because, even if you don't have net income, you are subject to the gross receipts tax. Also, the potential of new entity level taxes. Of course, that might cost the states a little bit. I don't know. So you just have to think about that. Then there's the option of broadening the sales tax base and raising the rates, possible focus on taxing digital goods. A number of states currently tax digital goods like, downloads of music, of books and things like that. But also digital services like advertising. Washington, D.C. and Maryland both recently tried to enact a tax on digital advertising. Fortunately for, some of your big digital advertisers, that didn't go through, but I think that's an area where the states are going to focus. And also anything in the digital online e-commerce area, I think that's fair game for the states. And then also with recreational marijuana, I think it was 5 states that passed, the voters passed referendums or passed, I don't know, legislation or whatever. They agreed to have or allow recreational marijuana in the state. So the states will be that passed that, I think it was Arizona, a few others. Anyway, they'll be taxing those at a higher rate than your normal sales tax rate. So definitely something to think about. Also challenges to Public Law 86-272. If your business has just been soliciting sales of tangible personal property in the states and you've been taking advantage of that public law saying we don't have a filing requirement, or even though we might file, we don't owe any taxes in those states because we're only soliciting sales of tangible personal property. That is definitely ripe for challenge, constitutional challenges, particularly after the U.S. Supreme Court ruled in Wayfair that sales tax and economic nexus was appropriate. And then also you think about possible legislative changes to create tax amnesty programs. So that's, even though they might be giving away interest and penalties, they will be getting in a quick influx of taxes. So they definitely might be considering this. And what Kiter, SALT, presentation would be complete without this slide. You know, you all seen this slide before, and hopefully you're thinking, well, it's nice seeing a slide of the U.S. without red and blue coloring, but this is our sales tax nexus, our economic nexus slide for, you know, due to the Wayfair case that was passed or approved by the U.S. Supreme Court back in June of 2018. So if you're looking at the chart, all the states in kind of the orangey brownish color are states that have adopted economic nexus for sales tax. So if you are selling into those states, and your sales exceed those certain thresholds, you may have a sales tax collection requirement. States in purple are states that do not have a state level sales tax, although in Alaska, it's important to note that there are local sales taxes. So kind of consistent with these other charts that we've been seeing, or maps we've been seeing, maybe Alaska should be striped, you know, because you do potentially have sales tax collection requirements in Alaska at the local level. But it's important to note that with you know, the states are enforcing Wayfair, you know, the economic nexus, even more so than before because of their situation. And a lot of people are saying, well, it's because of Wayfair that the states have been able to remain afloat, because with the online shopping due to the pandemic, this has essentially created a boon for the states, you know, in receiving at least some sales tax revenue. So just be aware that if you are thinking about or are doing business in other states and don't have a physical presence, that you might have a sales tax collection requirement if you exceed the small seller requirements in those states. And you'll note from the chart that Missouri and Florida are in white, meaning they have not yet passed economic nexus. So you can sell all you want in Missouri and Florida right now anyway, but I would bet that this is the 2021 will be the year that both states enact economic nexus. And you'll note that Kansas is kind of highlighted in blue. That's because Kansas does not have a small seller requirement or exemption. I mean, most states will say if your sales are less than 100,000 or fewer than 200 transactions, then you don't have that tax collection requirement. Kansas says we don't have that requirement. That first sale into Kansas, assuming it's taxable, is you should be reporting that. So just to
Terry.
Yeah.
One thing to note on this, obviously, if you sell tangible personal property, it's definitely something that you have to be considering. But if you sell services, there are several states out there, even though you're in professional services. Pennsylvania, West Virginia is another close one that have tax services. DC taxes a lot of services. So even though if you have a lot of large customers and you have a service, you definitely want to be checking to make sure, you know, and for financial statement purposes, attestation, you know, making sure that we've seen an increase in during mergers and acquisitions where there are reserves. And if you're considering any type of, you know, merger or acquisition in the future, you definitely need to make sure you're on board with the sales tax and collecting it in the proper states. Lots of articles out there about Wayfair and you know, making sure everything's being collected properly.
Right. And something I'll talk about in a minute is it's not where you as the business is located, it's where your customers are located. So that's something you need to be aware of. So yeah, we'll talk about that in our considerations for the future. And so we got the guy with his little crystal ball. Don't do this. And however you interpret this picture, you know, it's whether, you know, don't let your dog dig in your yard, or don't let your dog dig in your neighbor's yard. As my mother used to say, well, if you want to save your money, you know, the only way to be sure is secure. If you put it in a tin can and you bury it in your backyard, I wouldn't recommend that either. But the thing here, our purpose with this picture is don't, you know, hide from your potential liabilities or your responsibilities. It's not good for business these days. But what should you do, you know? And we're recommending, I mean, and it's not only because of the COVID-19 situation or the state budget deficits, but it's just part of just general good business is you reevaluate your state and local tax filings, not only in light of telework or everything else, but just, you just have to think through this on a regular basis, and you need to consider the following, like, with Wayfair, the potential sales and use tax responsibilities in the states, or even with the income tax implications, potential economic nexus. You need to think about where your customers are located. With a lot of the states, we now have market-based sourcing, so it's the receipts are not sourced to where the service is performed, but it's where the benefit is received. So it's where your customers or your clients are located. So something to think about there. Also think about, in the old traditional world of, physical presence, if you've got traveling employees or independent contractors moving around, that is creating nexus for you. So think about that. Also, as Kay was mentioning, estimate any liability for financial statement purposes. Think about or evaluate what you've been doing, potential exposures, potential liabilities. And this is particularly important if you're looking to sell, in 2 to 3 years or 3 to 5 years, that you want to get your ducks in a row. You want to be sure you've properly reported and paid the amount of taxes that are due, or reasonably paid them, if you are looking to sell your business, because it will definitely be an issue in the due diligence process. Also, you want to think about, tax amnesty programs. There are currently many out there. There are, I think, 2 states that have them. Washington State, and as I said, Washington's very aggressive. They have an amnesty program through the end of November. So if you've got potential Washington State exposure, jump on it right now. Nevada has announced that they are having an amnesty program sometime before June 30th, 2021. So something to think about there. But again, to the extent that states have tax amnesty programs, you might want to consider them, because it's an opportunity to avoid some interest and definitely penalties. The same with voluntary disclosure programs. The states are, always have voluntary disclosure programs available to taxpayers, where they can come forward. They can limit their look back periods, limit the amount of tax that's due, a lot of times avoid penalties, and sometimes limit interest. So it's definitely something to consider if you want to potentially clean up prior years and get straight and compliant going forward. And don't think about, or don't just assume, that the taxing jurisdictions are going to be forgiving right now. You'd like to think everybody's trying to work together. It's a tough time. But yeah, but they're desperate for money. So hey, just don't assume. So now our polling question number 4, as we're trying to wind down the presentation. Claire, if you could release that. Yep. So what do you think the states will do to make up for revenue losses? Raise the sales tax rate or broaden the base, raise income tax rates, increase audits, all of the above. Personally, I think, all of the above are an option, but please respond if you will. Okay. So Claire, how are we with our responses? Okay, we got 93 responses, and the survey says.
That's a drum roll.
All the above, which I think we kind of expect. I think it's going to be kind of a combination, or potentially a lot of different things going on as the states are trying to prepare for and decide what to do going forward, and we just need to be prepared for those. So, and Claire, if you would close that out. Okay. And then finally, Kay and I have concluded, what we intended to talk about today, not to scare you into, running to tax compliance, but just to make you aware of the issues that are out there. There are a lot of issues. There's a lot of uncertainty, a lot of things to think about, but things to keep kind of top of mind as we, go into year end and approach the new year. As far as other opportunities for CPE, we're all desperate for CPE this year because it's been a challenging year. We do have some upcoming tighter webinars. We have a not-for-profit update in December 4th. And we also have a state and local tax seminar planned for December 9th, where we're going to talk about sales tax audits to help you get ready for those audits that might be coming because the states are so desperate for revenue. So that's and CPE will be provided. So if there are any questions, we're happy to answer those. I know, Kay and I, we always run right to the end of the, the hour limit because we have so much to share and we want to share that with you. But if we haven't had an opportunity to answer any questions, certainly here's our contact information and feel free to reach out to us. Again, we will be sharing this presentation with you. So thank you for joining us today. And good luck with the year-end planning and next year coming up. And please do join us in December for our sales tax seminar. Thanks.
Thank you.
Thank you.